Hey there, everyone. We are live. Thank you for joining me for a special edition of Be the Boss of Your Money. Man, oh man, did the stock market ever get pounded. All right, so I don't want to miss anything here, but I looked today at stocks like Netflix. Why would Netflix be down if people are worried about coronavirus and staying at home? So the selling was widespread, indiscriminate. It's pretty much everything out there was sold off today, except for the handful of a few stocks. I think Clorox was up a little bit. Gilead was up a little bit. But these stocks were up just basically they were considered corona plays. Clorox, bleach wipes, and it'll help. People will use them to wipe things down. I don't know if that's really enough to get Clorox going, but that's the play of the day. What we really need to take a look at, though, is what comes next. And I think there's a trend that's been evolving, telecommuting, working from home. This could possibly hasten that move. So I would look at anything that involves you looking at a screen. So it makes no sense why certain stocks were down today, because to me, stocks that are play at home kinds of stocks or things that keep you busy when you're under quarantine. I mean, what would you do if you were quarantined in your home? You would basically look at screens every day until your eyeballs fell out, because you'd be so darn bored. There's nothing to do. So I think screen stocks, looking at screen type of stocks, should actually catch I shouldn't say a bid, but they should be viewed differently, in my opinion. I want to share my screen with you and show you a couple of things. Okay, share screen one. Okay. Can you see this, everyone? Share. Coronavirus to cost airlines more than $29 billion in revenue this year. That's just one really horrendous headline. And you can infer from that what you will, but I'll infer that it means that the movement of people around the globe has come to a screeching halt. And when people don't move, business doesn't happen. Because we all know that at some point, a handshake, a face-to-face contract signing, those are still important. Not everything is done without that. The S&P 500 just passed its highest valuation level in almost 18 years. This is written by Jeff Cox at CNBC, someone I know and respect tremendously, and someone who I just spoke with about a week ago. So these are the kinds of headlines that you're seeing. So if you take a look at sky high or high valuations, and if you take a look at money coming into the market, and you look at what a lot of people maybe haven't looked at, is a slowdown in stock buybacks this year. You couple that with a black swan event, an unexpected event like fear of the coronavirus, you have the perfect storm for a down market. And we would, to get into correction territory, Dow would probably have to drop about another 1,200, 1,400 points to get us to a 10% correction from its all-time high, which we were just at highs last week. I just have to say this, that the Dow Jones Industrial Average, the S&P 500, these are indexes. You cannot invest directly into an index, but you could invest in a security that mimics or tracks an index. Okay, just have to get that out of the way. So the headlines were awful. Goldman Sachs cut its estimate for U.S. GDP for the first quarter by a pretty good amount. Other countries, from South Korea to Austria to Italy, countries, Iraq, even countries are slamming their borders shut. So borders are closing all around the world, and people have their a handle around this particular virus. Okay, so it's not starting, it's spreading all over the place. I just want to change my background for a second because I'm getting sick of looking at the one we had. Okay, New York Stock Exchange. Nothing says financial advisor more than the New York Stock Exchange right behind you, right? So that's why the Dow went down. Now, what should you do? So you have to make sure that you have properly moved money that you're going to need for financial obligations out of the stock market and into something more stable, cash equivalent, CDs, etc. A lot of people have gotten complacent. Maybe people took their eye off the market, and toward the end of the day, people started to realize how much things were down. And then people started to say, wow, I'm up so much in some stocks, I have to just start selling like crazy and taking profits wherever I can get them. That's what it looked like at the end of the day, a swoosh into the end of the day. But it didn't really have the feel of capitulation, of panic, of people running out of the market. We would need a little bit more what I call technical damage to the stock market to get to that point. We could get to that point pretty quickly at this rate. If we go down 1,000 points every day, the Dow is going to be at zero in like 28 days. I don't think we're going to zero, but I don't think we need to be heroes and take a shot on stocks immediately either. I don't like all or nothing trades, but if you are looking to put money into the market, you might want to start nibbling. You could nibble with exchange traded funds. You could nibble on individual stocks. Maybe scale into a position. So let's talk strategy. Scale in. You're going to buy 1,000 shares of a stock. Maybe buy 200 shares now. Put a buy limit order in 5% below today's price for another 200 shares, and keep doing that until you have your order filled. This way, the order will be there when the stock or the ETF hits those limit orders. And you won't have to rely on your own discipline to make sure those limit orders are filled, because that's what happens in a market like this. When things are moving very quickly, people lose their discipline. They start to say, well, I'll wait, maybe not now. Now's not a good time. I'll look tomorrow. And then you miss your opportunity. Folks, there has never been a time when the market didn't go down and then recover. It's always happened. We've always had a recovery. Now, we could be in for a painful period of a month, a week, a year, 2 years, 3 years. Every time the market has a sizable drop, it feels the same as, a 1 month down market or a 1 year down market or a 2 year down market. So that's why you have to be disciplined. You can't control what the market's going to do, but you can control your own behavior. And that's what I'm looking to do. Today was actually not an overly busy day, a few phone calls, but did I feel compelled to make any moves? Did I have to sell anything in dramatic fashion or buy anything in dramatic fashion? No, I did that already. And it's not because I'm clairvoyant or I knew that the Dow was going or the major averages were going to tank today. It's because it's because I do the day-to-day things as a financial advisor to be proactive, to get clients. And you can do this either yourself or with a financial advisor. You do this. And it means you don't have to be reactive every time the market goes down. You already are prepared. Listen, if the